So to talk more about this, emerging managers and how to make the most of the opportunity, let me welcome your next moderator, Lizanne Atherly, excuse me, founder of Minds 2 Capital.
Hello, everyone. Welcome to the Emerging Managers panel. Are you all ready for an exciting conversation? I want to make this as interactive as possible. So if you have questions or comments while we're talking, please do put your hands up. My name is Lizanne Atherly. I'm the founder of Minds 2 Capital, based in Zurich, Switzerland. I work with family office investors to find new technology companies, and we invest via smart capital syndicates. So without further ado, I'd like to welcome my fellow panelists to the stage, Stanislaw and Gregor. Please give them a round of applause. We need a mic for... Please have a seat. If you guys could just briefly introduce yourselves to the audience and give us your backgrounds.
Hello, everyone. Thank you very much for having me. My name is Stanislaw Kastory. I'm a founder of a Polish family office and Firlej Kastory and our venture arm Expeditions Fund. We invest as a family office in other funds, so we act as a fund of funds, in fact, and we also invest directly, but on a little bit later stage than we do it in Expeditions Fund. As an Expeditions Fund, we do direct investment, early stage, so we actually are very similar to typical funds. The only difference is that we are strictly private, so that's our definitely competitive advantage.
Thank you.
Hi everyone, my name is Gregor. Thank you for the Frenchiation of my name. I'm partner and co-founder of Blue Future Partners. We are a fund of funds, and I'd like to call ourselves a boutique fund of funds because we only invest in emerging managers. We do this globally, typically a 40-40-20 split across the US, Europe, and rest of the world. I'm very thankful for joining this panel today. Thank you for hosting us on this, and Jan for having us join. I'm kind of finishing off on 7 days of tour from Iceland. Sammy, I can see you out there, and also kind of Helsinki. So it was really educational. I'm spending some more time here, and I'd like to kind of break the ice to get this 9% bar up to 20 or 30 as soon as possible.
Thank you, guys. Now, you both have very different approaches and very different backgrounds. Can you give us an idea of why you set up in the way that you did, particularly as a family office that also has an emerging fund, and then what your institutional approach is and why you were set up that way?
So I would like to give you a little bit of background of not only our fund, but the situation in Central Eastern Europe. So you're probably aware of the history of Europe, of course, and wealth in Central Eastern Europe was built for the last 30 years, after the Soviet Union collapsed, of course. So the concept of the family office, it's something brand new. There was no need for such an entity in Poland, Romania, Bulgaria, in Estonia, Latvia, before, because there was no wealth to be managed. And the wealth was built for the last 30 years. So now, we have a second generation. Finally, we have this problem not only to build wealth, but how to manage that. And it's why we decided to structure a family office for our families. So I'm referring to my family, my wife's family, and my family, and the family of a very close friend of ours, to have this entity that we manage and which is investing into different opportunities. Then we realized that it's not only that also other high-net individuals, families need such a solution. So we invited our friends, partners to join us. But we didn't want them inside the family office. It's why we separated and have Expeditions Fund as a separate entity. And in Expeditions Fund, we have a group of 34 LPs, which are all like top people in their sectors. So that's the thing I want to elaborate a little bit more later. But for us, the core thing is about the uniqueness of the group of LPs. So the value they provide, the knowledge they provide, and the strength of the network.
Thank you very much. And you?
So, listening to your story live here, we had a little preparation, but I see a lot of similarities of what we've been up to. When we set out in 2013-ish investing in venture capital, I started a software company myself in the mid-2000s, went through that process, and like every kind of founder, I started angel investing, and we realized pretty quickly that angel investing is a pretty difficult thing to do because you'd be competing with venture capitalists doing that full time, and we didn't feel that we'd have the benefits of doing what we wanted to do. Being kind of Germany based, we wanted to diversify from the euro to the US dollar, and we were kind of strong believers that talent is kind of equally distributed around the world, so we wanted to get exposure to venture capital globally. And again, this sounds like a humongous task, and I can just say it actually is. We kind of set out to do it by talking to the fund managers we believed kind of delivered strong returns, going to the US, and that started kind of in 13, 14, 15. And we were very, very fortunate, I have to say, by meeting some managers that were kind of willing to listen to us because we were kind of a no-name out of Germany wanting to invest in the US. And we backed a manager very early on, actually 2013 already, who turned out to be one of the best funds at on the East Coast, 20x Fund Plus. And we kind of saw certain patterns they had building up their firm, which got us really, really excited about emerging managers. And I think that's how we actually build a firm around this. So we said, okay, if family offices, high net worth individuals want to deploy money to venture capital, let's create an access for them, how they can actually do it, kind of meeting those requirements of global diversification and so forth. Basically, this is a fund-of-fund structure we're running today, but I think by focusing on emerging managers and getting this kind of regional diversification, we're actually offering something quite unique in the sense that you get the high returns you'd expect if you go in venture capital, and you have the downside protection of a fund of funds kind of offering. So yeah, that's how we ended up doing this. And I kind of want to point out here, very important, I think it is very, very fortunate situation to be in. We get to kind of spend a lot of time with and that's where I see the similarities with great families. Our investor base is like 60% European and 40% Asian. Having kind of people back us, being able to tap their networks, and at the same time talking to managers that are kind of willing to partner with us. It's a great opportunity.
Thank you both. Now, we all know that the last 18 months has been a challenging time for the environment, particularly for emerging managers to raise funding. And before I ask you those questions, I want to ask the audience, how many are invested in emerging managers currently? How many are still investing in emerging managers currently? One hand, two hands, okay. So it's been a challenging environment. Good for you. I'm going to ask you a question later. It's been a challenging environment. So what are some of the things that emerging managers can do to raise capital more effectively in this environment?
So first of all, I think it's uniqueness somehow, because it doesn't matter what is the market situation when you are a really outstanding person. So in current market situations, there are also rounds that are really high, that where funds are fighting to get access to. And if you are very good or you are unique, there will always be capital for you. It doesn't matter if you are an emerging manager or you have a technology company. So I really believe that uniqueness and story is the most important, because if the fund approaches me and says, okay, we will do B2B or B2C marketplaces, there is no uniqueness in that. Tell me, okay, if you want to do marketplaces, why do you think you have the best access to people who will be starting those marketplaces? That's the value. So as an expeditions fund, we are investing in Polish Sea diaspora, and we really believe that we have unique access to those people through the best universities globally, not in Poland only, but globally, in Oxford, Cambridge, Ivy League, and there you have a huge number of people coming from our region to study there. They are the most talented ones. And we want to have access to them to be able to invest in them when they decide to establish their own companies. So first of all, uniqueness is very important thing. Second thing I would say it's a network. It's a network. It's constant fundraising and caring about your current LP group, because we are in a very similar position right now. So we will not be able to show returns in 2 years when we will want to fundraise again. But somehow we need to show our LPs that we are trustworthy. So what we are focusing very strongly on is to make the network that we already have inside our fund connected to us, connected to each other, so they feel like a group, that is connected through the expeditions fund and is doing different things together, and that works for us. So if I'm able to connect my one LP with the other, and they can start their own business, or one will solve the problem of the other, that build a unique connection that will benefit from in the future.
Thanks very much.
Sorry for taking this a
Greg?
little bit too long.
Sorry.
I had a couple of points here. So I think one of the recommendations I'd have, if you need to fundraise now, kind of to postpone the fundraise as long as possible, to kind of spend way more time on pre-marketing than people used to. So coming from an environment where we were chasing managers, taking them out for dinner to get allocations, it's the other way around. So I think the typical emerging manager we see will want to invest and not fundraise, which is natural. I think to kind of shift your mindset to say, okay, how can I gather a group of LPs that will actually be valuable for me, that it's worth spending my time with, not only for the fundraising, but all over kind of my fund cycle. I think this is the main recommendation I could be giving people, saying, okay, try to set up kind of a set of LPs that will be valuable for you in the future. Just to give some very concrete examples. So we are invested in a UK manager. He's on fundraising Fund 3 now in fall. He's somebody who returned more than $1 billion in his prior positions to his investors. He set up his first fund. He did his first close at 8 to 10-ish million. We were backing him in Fund 1. And he has always taken a very, very humble approach, saying, okay, what is it I'm trying to build? I haven't done it before, so let's talk to the people I can. And he really gathered a great group of LPs, and he fostered this dialogue, which makes us, obviously, as an LP, way more willing to support him. So he's gotten 10 intros from us to our existing LPs to go directly with him, which 5 of them did. So I think spending this time on your LPs and actually using this hub and spoke model, that will scale your fundraise.
And what about for the existing managers you have in terms of their ability to fundraise? So from an LP perspective, we just did the GP's perspective. From an LP perspective, what advice can you give LP investors when looking at investing in emerging managers or re-upping in the ones they already have?
Yeah, that's a good point. I think for us, the definition of emerging manager would be Fund 0, or 1 to 3, and sub 200 million, right? So this just everybody uses a different definition on that. It was very easy to fundraise in the last 3 years, pre the crisis. So and a lot of people came back to the market so quickly. So we had a lot of people, fairly talented people, going back to the market 18 months in, super fast deploying kind of their previous funds. So I think it's a special situation we are in now, that a lot of funds will come back to the market with Fund 3. And they will, you won't have any data supporting to re-up. So I think this is a tricky one to look at. How are these managers, when you consider kind of re-upping with the manager, how can you kind of assess their capability to actually close the fund? Because we've seen this a lot, that people are slowing down on fundraisers. They won't reach their targets. That has a huge impact on portfolio construction. And there's a lot entailed, basically, I think. which will make it. I mean, it's so unfair because everybody will just wait for the final close these days, right? And us fundraising as well. We can see this. We have a long list of people, and we're entertaining discussions all the way. But everybody's going to wait just to the end until they sign. So I think everybody's looking at fundraising capabilities these days, and I assume that's something you have to kind of look out for way more than we did in the past.
Yes, I fully agree on that. But there's my recommendation to LPs would be to invest now, because that's pretty simple. You want to invest when it's cheap and sell when it's expensive. So now it is cheap, and that's the moment to invest. That's the moment to support emerging fund managers.
But what's the sweet spot then? So where should we invest? Where are you looking? What kind of criteria you're employing?
And I will say AI right now. So why we are looking at AI? So our thesis behind AI, it didn't start 5 months ago, but we believe from the start that you should only invest in AI first companies. And by AI first companies, I don't mean the companies that have this functionality like ChatGPT, but companies made by people that really understand the technology and are able to create something new. So definitely speaking, the old style AI and new style like ChatGPT AI will be a huge thing right now. And I strongly believe that it will last much longer than, for example, crypto. So I would definitely look for competitive advantage based on really proprietary technology. That's core.
If I could just add to this, I think chunking up a bit for LPs, it's the question which if I do private equity, if I do venture capital, what kind of exposure can I build in venture capital? And most of our LPs were considering, well, we do some early stage and we'll do some later stage and some pre-IPO and so forth. And even 2, 3, 4 years ago, these larger players doing kind of providing founder liquidity and running around the globe, buying very expensive companies, it was kind of foreseeable that at some point the bubble would burst, and now they're all kind of pretty burned. So I think if you look at yourself as an LP, where is the most value being created? It's an early stage. Why don't most of the people go in early stage? Because it takes so long for the value to be created. It can take 10, 12, 15 years. So I think if you are patient capital, and for us, our investors, kind of family offices, at least claim that they are patient, I think that's what you should be looking at, right? It is very, very important. Go in early, build enough keep enough reserves to actually be able to deploy very regularly. And earlier panel today mentioned this as well. You don't want to time the market. You want to go very systematic. And then basically from building up your pool of potential deals, you can then obviously pick from your portfolio and say, okay, I'm going to go Series B with this one and co-invest alongside. But I think that's the most important one. What are you looking at? And I think value creation is in early stage, so I'd be kind of supporting highly that kind of part of the market. And then obviously there are secondary opportunities out there, quite interesting. You know the analogy with the falling knife and not trying to catch it, but there's definitely a lot of secondary LP interest you could be buying from people who kind of over-allocated and need to get out. That could be a pretty interesting spot as well.
Thank you. I'd like to open it up a bit. There are some people that raised their hands. I'm looking at one. You're still investing in emerging managers. So if you wouldn't mind sharing with us, what's your sweet spot? What are you looking at? And yeah, just
well, I don't want to steal my co-founder's thunder, Sarah Chen, but I'm Shelley Porgas. I'm managing partner of Beyond the Billion. I'm going to moderate the next panel.
Excellent.
And as always, I invest in female fund managers who invest in female founders, not necessarily exclusively, across the spectrum of categories. And Sarah probably told you about it earlier, a little bit, that we have 110 partner funds across the globe, and I have personally invested in some of them.
Thank you. There were also some hands. Thank you very much. Let's give her a round of applause. She's still investing. Yeah.
So it's linked to Shelley's.
Excellent.
I wanted to know from both of you what percentage of investing in emerging
Thank you for asking that. That was going to be my next one.
Should I hit first? I
He
do,
knows,
I
he
do,
knows.
absolutely
He does
do.
know. I prepared
Yeah,
him
so
for this.
we spent a lot of time the last 4 years or 5 years trying to understand our own bias as a firm, and we had a very fun panel actually at Slush last fall here discussing this. So everybody who started the firm in the room, they were kind of the typical stereotype of what you think would be making the wrong decisions when it comes to diversity and gender diversity. So we tried to kind of learn and understand what we should be doing. We spoke to a lot of people in the ecosystem and tried to build or revamp our investment process to actually get to see the stuff we should be looking at. And we came to the conclusion pretty quickly that a mere ESG lens, what everybody was talking about in 16, 17, and so forth, wouldn't be working for us. And we started the process by monitoring what our underlying portfolios looked like. So our first vintage was 2016, 2019, 21. And by tracking all the underlying portfolio companies, we kind of could see how their exposure grew over time. So I think we made significant progress. We have 25% plus kind of female founders at the underlying portfolio level. When it comes to the GPs, we track by GP. That's a pretty runners up, 24% or so. And then female only led, we have one US manager, which was founded by kind of the ideal combination for us, ex-NEA, kind of investment professional and hyper operator out of the Uber network. Basically, she operated a division at Uber, and they set up a fund, which we were really, really excited about.
So in our from the family office perspective, we did already 4 founder-funded investments, where one of them is run by Sarah. It's a social impact capital, a fund from New York, focused on impact investing. And regarding our portfolio in expeditions, I would say that's probably around 10%. And that's pretty. I always have a problem with this question, because underrepresentation of women, it's huge. And even if you want to invest in companies that are run by women, there are much less opportunities on the market. So it's a very, from the strategy perspective, it's a very difficult thing to do. We even from HR, so our experience when we are looking for new employees for our VC fund, the number of male candidates was much higher than female candidates. So that's the issue I have. So I would really like to have more female founders, but it's not that easy.
I would challenge you a little bit. So it really depends on where you're looking, right? And who you're looking with. You mentioned the networks being really important, right? Well, you mentioned networks being really important. Mm-hmm. And I feel like I always hear this as there's not enough, we don't have enough applications, and maybe that's true. But then, like, who are you partnering with so that you're more intentional about finding talent, not just finding women, right? So that it kind of is more equitable in that way. Just my 2 cents. So we are not really writing on applications. We are we are trying to find the employees. I don't want to go too deep on that, but we are reaching out to people from our network in the universities we know, looking for recommendation for most talented guys they know, and that's the way we try to attract talent. So it's really, you know.
But I do agree on your point. So in every kind of region, you'll have kind of hubs trying to help people, like Inclusive here in Finland, and we have a similar thing in other regions, obviously in Europe. And I think that's a great way of doing it. If you kind of and we had 3 interns from there, and 2 turned over kind of to become team members. I think that's where you can actually start sourcing those, but you have to make a deliberate effort to reach out to those networks. And I think it's quite difficult because, as I mentioned earlier, people will be extremely critical. That you'll get this, are you trying to kind of use us or leverage us to do something, to look good or something? But then we had this exact experience. So there's a prominent fund in the US which raised a lot of capital, like in the 3-4 last years, raised like $850 million as an emerging manager, and this, don't want to mention the name, but it's potentially obvious. And we had this deal on the table, and the manager said, why should I be taking you as an LP? And they had a quota of which of LPs they would want to be taking. And we had an intern who came from one of those programs who pushed for doing this, right? And he, as an intern, connected with this GP, very successful guy, and he actually got us the allocation. So now it's a really weird setup, but it is a game changer for the firm itself. So I think our business model required us to set up kind of fairly internationals. We have Chinese and Israeli and Portuguese team members. Kind of, it's for a German firm that's quite unusual to have this mix of people, but it gets better. I think the deals get better opening up, and that's what I'd say to every investment professional or every CIO: try and get a diverse team as possible, because that will find you the returns of the future.
Thank you, and I just want to bring it back more to the emerging manager conversation now, since we have a few minutes left. There were a few hands in the room that have stopped investing in emerging managers. I think they were in the middle of the back. They're hiding now. Are you guys hiding? I was just going to ask you why you stopped, because from a devil's advocate perspective, we've been very bullish about emerging managers up here. But why have you stopped? And I just want to ask the panelists to address, the slowdown in fundraising in terms of the vision for the future. But maybe we have anybody from the audience want to contribute why they stopped? Off the record, for sure. No? No takers? Am I going to have to point you out? No, I'm kidding.
I can definitely take that one for the audience, because I hear this a lot from LPs. I mean, it's very, very obvious, because most of the LPs don't have any capital to deploy. Full stop, right? They'll, like more institutional endowments I speak to, they have the denominator effect with their public holdings, whatever it is. Everybody had a hell of capital calls from prior funds. People came way too fast to the market. We were expecting 3 to 4 years. It went down to 18 months, and in extreme cases up to whatever, 3 years. So now, and you have this kind of continuous plan. So I think a lot of people were trapped into over-allocating, and basically they don't have any money left. I think that's, and this refers not only to emerging, but other kind of type of more blue chip established managers, and that will lead to a huge crunch basically in the next 3 or 4 years of people running out of funding.
I think we have, thank you. I think we have a question from the audience.
Like an evergreen kind of funds?
I think it's a very, very good question. I can give 2 examples, both on the fund-of-fund level and at the kind of lower level of a fund. And I'll take 2 German examples here. So one is Alpha Q, also Germany-based. They're trying, or their ambition is basically to solve access for venture capital for the long tail investors, and they want to list their entity. So they'll be kind of trying to come up with strategies that actually help that. But at the same time, they still continue to invest in closed-end funds. So I think the ambition is there. I can see that at a LP kind of level. If you look at funds, and I think one of the more prominent ones in Germany is Aenu, so founded by a guy who sold his company to Google, Fabian Heilemann. We've invested with him in the past as well during his time at his last firm. And I think it is extremely difficult to fundraise for those structures, because in a limited space of LPs anyway, which is European venture capital, it becomes more and more complicated, because most of the more institutional investors won't be able to invest because they have closed-end funds and they have the fund lifetime. So I think people are understanding that both kind of climate tech and these type of investments, and kind of not only financial return is important, but also kind of impact considerations need to be made. But they know that these firms are going to take longer. But I think the capital landscape isn't there yet to actually have those companies be supported.
Now we're almost out of time, but I want to leave it with this. One of the previous panelists said that European LPs need to kind of like get with it, and I agree. So as a couple of young LPs, you guys are pretty young. Is there hope for changing perspectives in Europe with respect to how LPs perceive investment?
So yeah, I think what's happening in Central Eastern Europe, I think we can share. I will tell a little bit more about Central Eastern Europe. Because this asset class is growing and the wealth is growing, there is definitely a huge potential in Central Eastern Europe regarding the growth of LPs and capital coming from that area. But we need a lot of education. So, for example, in Poland, the Polish wealth is dominated by the production sector. So we have biggest production of, I don't know, rubber parts to something. It's like that specific. So mindset in those sectors is completely different to the mindset you have in venture capital. So successful people from those sectors are, they believe that their way of thinking is the right one. They believe their choices, and they are not really interested in listening. Or maybe that would be too far. But at the end of the day, what they think that counts. And I believe venture capital is about discussions, and it's important that our wealth from our part of Europe needs to change the mindset and more adapt to the way venture capital is built.
Thank you. So there's hope then.
Yeah, I think yes. And we try to make a change, at least a little.
And you?
Yeah,
Greg?
so I think for us as a firm, we always see venture capital, and we use this metaphor and overuse it, I assume, seeing venture capital as the outsourced R&D department of the world. And if you take this approach, I think there's a huge opportunity, but a huge risk at the same time for Europe to actually seek that opportunity and say, okay, we need to reinvent ourselves. We went through a huge crisis, energy crisis, and so forth. We all know that. And basically, the backbone of the European economy has been SMEs, especially in Germany, which is kind of one of the large economies, obviously. And I think if we don't figure out mechanisms to operate in this kind of asset class properly, we will lose out not only on financial returns, but on Europe as kind of one of the kind of leading kind of destinations for investors, for talent, and so forth. So I think one thing I learned here is that in the Nordics, and I'll take an Iceland example here so that I can make use of what I learned last week, is that you'll have funds being backed, like emerging managers, 90% by institutional investors, right? 10% comes in from family offices. This is Nordics. In Europe, in kind of Central Europe, where I've been operating in most of the time, it's the other way around. You'll have emerging managers try to get money from family offices, and then basically institutions like EIF come in when everything else is settled, right? And it prolongs the process. It makes it extremely difficult for people. So I think we should try and get kind of the capital stack for these venture capital firms, the young firms, ready so that they have an easier time fundraising.
Well, thank you to our panelists, Gregor and Stanislaw. Thank you for listening. Thank you.